Number one is Apple, has been selected 33 times. The second one is Texas Instruments, 33 times. The third one is Cognizant Tech Solutions, 32 selections. Then Alphabet, 32. Union Pacific, railroad company, 32. Amgen, 31. Cisco, 31. Johnson & Johnson, 31, MasterCard, 31, and Microsoft, 31 selections as well. So those, it seem to be, they're making money, they're doing well, and if you own this portfolio, you've been exposed to these throughout all these years. So,
You might say that the man across the screen from me almost has a crystal ball. Of course, investing is a social science and nobody has a real crystal ball or even strongly predictive powers, but Carlos Diez, who created smart beta firm MarketGrader more than 20 years ago, has built a model that's demonstrated a strong tendency to beat its benchmarks. In fact, over the past decade, 90% of MarketGrader indexes, and it has close to 100 indexes, have beaten their benchmark. So we're going to talk about what MarketGrader's model is saying now, about Nvidia, about tech stocks, about what industries are getting hotter and colder, and this is relevant to you regardless of whether or not you actually invest in a MarketGrader strategy. So Carlos Diez, welcome.
Thank you, James.
So Carlos, since we last spoke, I've evolved this tradition of putting some humanizing lightning round questions at the top of the show. And you gave some great answers last time. In fact, your answers were so good, we brought them up at the top of the show, and that's what made this format change. So let's humanize you again to the audience with a few personal questions. Again, very casual, no need to think too much. Last movie you saw and what you thought about it?
Last movie I saw. I've been watching just series lately. I've been watching Masters of the Air, the Apple Plus show, which I love. I can't think of a movie, though. So maybe that is that.
All good. I'm kind of like you. I barely watch movies. I mean, sometimes on the airplane, like through the cracks ahead of me, like I'll see without the sound the guy's movie a little bit, but that's about it. Last time you played a video game.
I can't recall. Maybe over 30 years ago. I'm not a video game player, so
I'm in the same boat. Once it got past Pong, the balls, it got complicated, and the controllers got like 47 buttons, and then in the fighting games, it's like these complicated, like who possibly has time to develop expertise in this? It's beyond me, but a lot of people do. Okay, last question.
I was a huge Atari fan growing up as a kid.
Yeah, as was I.
It for me, and then I went as far as the very old Nintendo where you played
Mario Brothers, yeah.
Yeah, and that was it. That was it for me.
Yep, same here. I think you and I are roughly of the same vintage, so I hear you. Okay, now in full disclosure to the audience, I should say that BBAE does offer MarketGrader strategies in our managed accounts, but I'll say we choose to do business with MarketGrader for a reason. It's because of MarketGrader's track record. In fact, we're proud of what we offer. We have 3 different smart beta products. There's a core, kind of a basic one. There's a growth-focused one, which we call growth compounders. Then there's a growth and income-focused managed account, and these are based on Carlos's strategies. So disclosures out of the way. I just want to make that clear, although we did that for a reason. So Carlos, before we jump into the details, Can you explain just broadly how the MarketGrader model works?
Yeah, so it all starts with identifying company quality, right? So our primary focus, and this is going back to why MarketGrader was created. We created MarketGrader to understand and find good companies, right? Among publicly traded stocks. So the idea was to do a purely quantitative analysis, but using very traditional fundamental metrics to understand a company quality. And we break those into kind of like 2 main categories, GARP and quality. And GARP is, we never thought that...
GARP is growth at reasonable price, if someone's brand new to this, yeah.
Yes, exactly. Growth at reasonable price, precisely because we didn't think investors should have to pick between growth or value stocks. When you're asking an investor to do that, you're asking them to give something up, and you're also sort of asking them to time the market, right? Is it time for growth? Is it time for value? You can identify good, high-quality growth companies, but buying them at a reasonable price makes a big difference, right? So, and then the other part of the analysis is around quality. Regardless of what these companies do, you want to make sure that they're high quality, meaning they're profitable, they have defensible margins, they they're good stewards of capital. They basically manage the company, or management manages the company on behalf of shareholders. So we use 24 fundamental indicators to track or analyze every company initially in the US, but now globally, about 41,000 companies globally. And then out of that comes a score between 0 and 100 that tells us how every company is doing. We use that score itself, which we recalculate daily for all stocks around the world, to select companies to our indexes. So our indexes are sort of the next step in our investment process. We say, okay, now we know how all the companies in the United States, in Europe, in Asia, wherever, how good they are. And so we start selecting the best large caps, the best mid caps, the best, for the whole country, sector, and so forth. And that's what our indexes do. So to your point, we have about 100 or so of those indexes across all areas of the market globally. We think of those as building blocks. So, the best way to access US large, US small, or a US sector, for example. And then the next step is the model portfolios, which you described before, where BBA has 3 of these, and we use an indexes of index approach. So, or an index of indexes approach, I should say, where we take building blocks that I just described before in our indexes, and we combine them to give investors the most optimal exposure, in this case, to the US market. So our US core, which is my favorite portfolio, which is in the BBA platform, is basically a combination of our large cap, our mid cap, and our small cap. So we're basically saying to investors, MarketGrader does all the work in analyzing the companies, identifying the best, and then putting them in those indexes, and then putting those indexes, combining them as a Lego, if you will, in the model portfolio itself.
Great. And certainly if you go to bba.com/portfolios, you can see really excellent prior test performance to be clear, but prior test performance of those indexes, or the model portfolios, I should say. And if someone's, again, brand new to this, a strategy like this, a smart beta strategy, is essentially like kind of the meat and potatoes, a core building block of your portfolio. It's not meant to be a replacement for the next sexy biotech or the next Nvidia. This is something like potentially you might buy instead of SPY, like an S&P 500 ETF, something that does kind of gives you comparable diversification, but gives you a little bit more bang for the buck, or at least it tries to, in a performance sense. Is that a fair description?
It is, yes. And when you think about the term smart beta, which is really a classification / marketing term these days, in the smart beta, I think you need to start with the beta. So when you think about any
beta meaning the market, basically.
The market, yeah. So we start from the premise that you as an investor, doesn't matter who you are, you need to take what the market gives you. And we know that historically, and this is going back to the beginning of time in the US, the market's given you between 7.5% to 8% per year in real returns, after inflation. So first of all, make sure you get that, right? Then we do believe that you could do a little bit better by selecting companies based on the attributes that I described before. In the past, you could call that active management. But still today, there's people that think that by actively selecting stocks based on their own sort of qualitative metrics, they can do better, right? History has shown that unfortunately the majority of active managers underperform the benchmark.
Yeah, 94% of U.S. large cap managers underperform over a 20-year period. Yep.
Exactly. And that's not to say that there aren't excellent active managers out there. There are, but if you're able to find them, then the other problem that you have is, oftentimes the ones that were the best performers last year or last decade are not necessarily the best performers next year, next decade. So we do away with all that, but we still believe in company selection. So that's where our brand of smart beta comes in. There's other firms that say, our brand of smart beta is more value leaning, so we go against sort of the grain of the market, and we kind of weigh more heavily in the more undervalued names and less more in the more overvalued names. And there's comparable strategies like that. Ours, again, is based on company selection. And so we've shown over the years that by selecting in a rules-based, transparent, replicable methodologies like I just described, you actually do beat the benchmark. You do better over time than the benchmark. And so the analogy I like to use is we're not looking to have a super concentrated portfolio that just hits home runs. We're looking to have a diversified portfolio that hits singles and doubles, and over time, singles and doubles win the game.
Great answer, and let me. That opens up my next question. I was going to ask you. You're not. I mean, you're established. You've been around for more than 20 years. There's there, but it's a little bit of a David versus a Goliath. And you're on the smaller side of the investment spectrum compared to some of these big hedge funds or firms with armies of PhDs and supercomputers. And I haven't compared everything apples to apples on every single thing, but in general, like you're probably beating at least most of them. And I'm guessing that's because of the factors, right? Like, factors are reasons you buy or sell or hold stocks. And you mentioned 24 different factors. And you mentioned an important point. Traditionally investing is a bit tribal, at least between value and growth, right? Value, you kind of buy beaten down stuff that's not as sexy. Growth, you buy you're always looking for undervalued stocks. With growth, you think your bright future is even brighter than the bright future the market already expects for that stock, right? But it seems like you kind of knock down that wall and say we want to have factors on both sides. Is that accurate?
It is accurate. Essentially, there's 2 points that I would make. Number one is the market has a natural tendency to go up, and it will always have a natural tendency to go up because it reflects the ongoing growth of the companies.
Yep. 71% of years, yeah.
Yeah, and those companies themselves reflect the growth in the underlying economy, and in this case, the U.S. economy. We're talking about U.S. portfolios. So stocks have a tendency to go up, and so that's the growth aspect, right? So you want to identify the ones that are faster growers and so forth. But then here comes a reasonable price. Now, when you look at the other side of the equation and you think about value, value is important in the context of growth and the quality of the company. So how much are you paying for that growth, right? How much does every unit of growth, however you measure it, cost you? And how much are you willing to pay for that growth today, especially if it's discounted, far into the future? One thing that's important to us on the value side is make sure that we stay away from companies that are cheap, simply because they're cheap. Oftentimes companies are cheap because they're just poor quality, and maybe they're cheap on the way to being insolvent or non-existent. So we want to make sure that companies are reasonably priced relative to their sales, to their earnings, to their cash flow, and so forth within the MarketGrader analysis. So that's how we straddle both.
Got it. And it seems to be working. And I'm looking at some data, Carlos, that you sent me, because literally today, the day we're recording, you guys are rebalancing the MarketGrader core U.S. model portfolio, the one that you mentioned as your favorite. And the summary, 1 year return, 35%. That's excellent. I'm just going to see what S&P did the past year. It's going to be less. I just want to give an exact number. I'll go with 31%. So you beat the S&P by about 4 percentage points over the past year. I don't know if that's with a little bit more risk or a little bit less risk, but that's excellent for what we're talking about, which is, kind of a bread and butter beta-ish kind of thing. So seems to be doing well. Can you give us sort of some highlights, basically, of what your model, your crystal ball is seeing right now in terms of what industries it's liking a little bit more, what industries is like a little bit less, and like kind of what are the levers that it's using to make those decisions among those 24 factors this time around? Right. So a couple of things. I'll start by maybe doubling down a little bit on what you said at the start, which is the rebalance, right? Because the rebalance discipline in our indexes and our portfolios, by extension, is a really important attribute of the MarketGrader process, right? So we want to make sure that you as an investor can act upon the underlying research that MarketGrader is producing, but we're not asking you to be making stock selection decisions, right? Mm-hmm. The system does it for you. In order to do that, we need to have a rebalance discipline. So twice a year, the large
majority of our indexes, 99% or so, rebalance twice a year, typically on the third Friday of March and September. What that means is that on that day, actually it happens a couple of weeks before we have to, set everything up and plan everything. But we look at how everything is scored and we say, okay, we reselect the underlying building blocks, the underlying indexes. And when I say we reselect, we say, well, some companies, the score has slipped for various reasons, so we exclude those. That gives opportunity to companies with rising scores to come in, and so we refresh the portfolio, right? We remake it with a set of new 100 or 200 constituents, whatever that is. And then we also return the index to the target weight, and in this case, the model portfolios to the target weight. So having said all that, after all that shuffling takes place, you end up with a different makeup from a sector perspective, right? So we don't do sort of top-down, high-level like sector allocation, right? We're not issuing a view where we say we think technology is good or bad right now, or energy is good or bad right now. The system does it for us from a bottom-up perspective. So I like to call it the incidental asset allocator, right? So we end up because it's identifying where value is, where the opportunities, where the growth at reasonable prices. So
none of those factors basically target industries directly. They target companies, but you sort of get de facto trends based on which companies kind of fit the bill a little bit better or maybe not as well within those factor prioritizations.
Exactly. So I know that's a long answer to your actual question, which is, what sectors are we liking now, or what sectors is the system liking now? And so I took a look at that, as you know, and which I shared with you before the call, and we compared the sector breakdown against the S&P. And for example, you take consumer discretionary. We are 2 points overweight the S&P, so about 12.5 to 10.5. And most sectors are like that. There's a couple sectors where there's a fairly significant over or underweight. So we are overweight industrials, for example. We're 6% overweight industrials relative to the S&P. I think that I've always liked that sector. It's a big sector, big part of the U.S. economy, and it's always sort of a bellwether type of sector that kind of tells you, what's going on with a lot of the bread and butter companies in the U.S. across all size segments, right? Large, mid, small. That's one thing that comes to mind. Technology, we're a little bit overweight also, about 5 points overweight technology relative to the S&P. But again, if you think about the fact that we have large, mid, and small companies, the S&P only has the 500 largest stocks in the U.S. We have also mid and small. So I like to think that gives us the ability to identify up-and-coming, in this case, technology companies, and go beyond just the names that everyone looks at all the time.
Yeah. And let me just jump in. I mean, if someone watching this is again new to this, overweight, underweight, these are Wall Street, common words, but it's not overweight in the sense of being bad, right? I mean, this is just, you could argue that this is more correctly weighted for an investor who wants to perform well given MarketGrader's prior performance. So it's just relative to the S&P, this model is weighting technology a bit more. It's weighting industrials a bit more. It's weighting consumer discretionary a bit more. I'm looking at this thing you sent me, Carlos. Consumer staples, a bit less. Real estate, a bit less. Financials, a bit, decently less. Actually, healthcare, definitely less. Telecom, so in other words, there are relative differences, but it's not so much a value judgment as it is just what the MarketGrader model sees as performing better in the future.
Exactly. Yes.
Okay, so what about stocks? Can you share any specific stocks that jumped out at you? I think I've got your list, Carlos, of the 5 largest companies or most held companies by weighting, which wouldn't surprise anyone: Microsoft, Apple, Nvidia, Amazon, Google. Anything like catch your eye with regard to those or other stocks?
So one thing that I did is I went back and looked at the best performing stocks in the portfolio year to date, and that's what I think last night or so. Because going back to the point I made before about harnessing beta, basically the market return, and then trying to do a little better by selecting differently, selecting companies based on their quality. I try to see how much the performance of the best performing stocks in the portfolio reflects that. So I looked at the 10 best performers year to date, and
Hmm.
the number one is Super Microcomputer, another one of these AI sort of names that has just completely taken off, up 318%. And the second one is Nvidia, 83.5%. So, and those are the names that everyone's talking about, hearing about, that they're everywhere. Although we've held those for a long time because we've liked them fundamentally. What's really interesting is that when you go past those two, so I'm not saying they are the market; they reflect beta, but in a way, they sort of are a microcosm of what the market has been this year, right?
Yeah.
This large cap, tech, magnificent seven, whatever you call it. Below that, this is where I think MarketGrader is really different. The second company is I'm sorry, the third company in terms of the best performance is a company called Masonite International, up 55%.
Hmm.
I bet most people haven't heard of that. The next one is a company called Kinsale Capital Group. The next one is Vertiv Holdings, and then the next one is Abercrombie and Fitch. So they're not the top 5 or 10 are not the usual names. Some of the usual names there, you're harnessing that, and some other names that you otherwise would not have thought so, right?
Exactly. And I mean, to be fair, you guys, if I understand, had a big weighting on Nvidia, which turned out to be very good and very beneficial. So you correctly weighted a stock that performed well. But your point is, this is not a carbon copy of the Magnificent Seven. This is, or Magnificent Eight, whatever you want to call it. You've got a real blend, and this model is indeed finding stocks from outside. I mean, and that's unique because this year we've had only 24% of stocks of the S&P outperformed the overall S&P. And I think that's the lowest number in like 20 or 30 years, or maybe more, something like that, right? So you had a very small number of rowers moving the boat, right? And the rest weren't doing much at all. So if there's ever a time to be finding good stocks, I mean, you could argue it's now. It's that shows the better way to say it is it shows true ability in finding good stocks, because yes, you could have just bought the index and risen with the tide with those big companies. But if you're able to show that you have good stocking picking market in a market where it's frankly pretty hard to pick good stocks, at least in my view, that shows something.
Yeah, I agree. And using your rowing analogy, you want to make sure that when those 3 or 5 or however many rowers get tired, then that the rest of the boat can sort of that they can pick up the slack, right? So in that regard, the other list of stocks that I really always like to look at in this portfolio, but also our indexes are at large, is I want to see the companies that make it regularly into the index, because when you look at those names, you get an idea for who are these perennials, or like growth compounders that we call them. This really good company that sort of do well through market cycles, economic cycles. So I looked at the 10 companies that have the most selections to the portfolio. So the portfolio dates back to late 2007. The data that we have on this portfolio, like I mentioned before, it rebalances twice a year. So that, including today's rebalance, that adds up to 34 different rebalances, right? So 34 different opportunities for the portfolio to select any given company. So I'm going to read to you the 10 that have had the most selections, so
Yep.
that everyone can get an idea for what those are.
They've been drafted to the team the most, basically.
Yeah, you can. Yeah, it could be call it the Hall of Fame, right?
Yep.
The All Stars, or
All right, so 10 All Stars you got. What are the names?
the number one is Apple. Has been selected 33 times. The second one is Texas Instruments, 33 times. The third one is Cognizant Tech Solutions, 32 selections. Then Alphabet, 32. Union Pacific, railroad company, 32.
Interesting.
Amgen, 31. Cisco, 31. Johnson & Johnson, 31. MasterCard, 31. And Microsoft, 31 selections as well. So those, it seem to be, they're making money, they're doing well, and guess what? If you own this portfolio, you've been exposed to these throughout all these years. So I think that's really telling as to the makeup of the portfolio.
For sure. And by the way, again, for someone just new to this space, you certainly can go and buy a managed account. I mean, there are different ways. There's a Barron's ETF, different ways to invest in MarketGrader as a package deal. But your website also lists individual rankings on individual stocks. So someone could use it to pick and choose stocks. I think, Carlos, and please correct me or please modify this, but I think in general you would argue that the very best use of the MarketGrader rankings is not just to go in and buy one or two stocks and then sit there hoping. It's to buy a big basket because you're playing on statistical properties, and statistical properties need a certain body to sort of really exhibit their true spirits. Is that fair?
Yeah, that's fair. That's actually how I invest myself. I have for my core, sort of like the backbone of my portfolio, an index fund that tracks a market trader index, and that's sort of the what I continually invest in, no matter what the market's doing. Right, that's the backbone. I do like to probably a lot of your viewers and a lot of the BBA clients. I do like to invest in individual names because I believe in a specific thesis about how that industry is doing, or I like the company. But that's always sort of like in addition to what I do with the main holdings. So with MarketGrader, the product itself, to the point you were making earlier, if I could plug MarketGrader shamelessly a little bit here, is we have our clients that are BVA is a client that tracks these portfolios. We have other indexing clients that track other indexes, and they have ETFs that track those. But then we also have a research business where people come to MarketGrader and subscribe, and then they use our research and a lot of the tools we have there, a lot of ideas, a lot of screeners to find stocks that fit whatever they're looking for when they're making those selections, right? So our tool is purely quantitative, like I described before. There aren't any analyst opinions, or no one's picking stocks. It's all 100% quantitative, but it's a good way and that's how a lot of our clients use it, to confirm or verify what they see elsewhere, right? It could be a financial advisor. They see that their firm is recommending this stock. They want to see purely quantitative what MarketGrader says, or an individual investor is seeing a stock published, mentioned in the Wall Street Journal, or reading about it in a Reddit forum or whatever. MarketGrader gives them an ability to see what the actual numbers say, right, and what the value's like, and so forth.
Yeah, it's a great perspective there. Two numbers keep jumping out at me, and for people who watch my videos, I've mentioned this before, but if you miss the best 1.9% of trading days, this is according to a Visual Capitalist infographic, in the S&P 500 over the past 20 years, your returns would be 93% lower. And likewise, a guy named Hank Bessenbinder from Arizona State University found that since 1926 until I think 2020 maybe, just 4% of U.S. stocks contributed all the gains. The other 96% just matched U.S. Treasuries. So in a time sense, there's a very small number of periods that are delivering all the gains. And in a number of stock sense, there's a very small number of stocks that are delivering all the gains. So you got two very narrow windows. And I feel like there's two ways to play that. One is kind of the Warren Buffett / Charlie Munger way. Warren Buffett says, invest as if you've got a punch card with 20 holes in it. You can only buy 20 stocks. Charlie Munger says, buy as if you go and buy 3 or 4 stocks. And his daily journal held only 4, I think, last time I checked, right? So he was walking the talk. The other way is to say, look, I want to, in fact, buy a lot of stocks because I'm not going to be able to pick those 4% very well, probably. And I'm definitely not going to be able to pick the 1.9% of trading days to jump in on. By the way, if you'd missed the worst 1.9% of trading days, your returns would be more than 2,000% higher. But, I don't know about you, but I can't get in just for the best and step out just for the worst. So in other words, the strategy there would be to have a wide number of stocks and hold them for a long period of time, cast wide nets in both of those dimensions. So at least for me, I feel like that wide net strategy is the much better use of MarketGrader's insights. Sure, you could go in and pick and choose stocks and buy and sell. But for most people, at least for the bulk of their portfolio, it would seem like a broad strategy is probably the better way to go, just in my view.
Yeah, I agree with that. If you think about some of the numbers that you cited, even let's say you assume that you can find what those 4% are, right? If you go back in time and you look at the 4% that have been the biggest contributors, now and X years ago and so forth, they're very different companies. The best companies today are not the same as 5 or 10 or 15 or 20 years ago. So you're assuming that you can identify those. So to your point is yes, stay invested, always stay invested, and do so through a broad strategy. Hopefully a market grader type, index fund. But having said that, it's perfectly fine to also select stocks on the side. I've always said that when it comes to selecting stocks, and this is for everyone, very experienced or novice investors, temperament is a lot more important than skill. Because you can always say, oh yeah, be fearful when others are greedy, and vice versa. That's easier said than done. When you're seeing losses in a stock that you like, do you like it? When you see a big drawdown in a stock that you like, do you like it so much still that you're now able to dollar cost average down and buy more of that? Because if you liked it when it was 30% higher, do you can you put your money where your mouth is and buy more of that? So it's just behavior, right? Human behavior is what it is. It doesn't change, and it affects all of us.
Yeah, so true, so true. The other thing and you mentioned smart beta is a totally different topic to Carlos, but you mentioned earlier about smart beta companies tending to have a value lean, which I think tends to be true. They tend to pick factors. And again, for perspective here, if you look at smart beta ETFs, for example, you'll find a lot of them out there. In fact, inflows have been pretty great over the past couple. Last year wasn't so good, but the past couple of years before that were quite excellent. Most of them are kind of small number of factor ETFs, 3, 4, 5, 6 factors, something like that. So 24 factors is far more robust. But the narrative in the media is that smart beta was beaten down, and now maybe value is going to come back eventually, right? It's been waiting for that for a while, but value is going to come back eventually, and maybe smart beta will do well. Do you think you're immune to that because you already have growth baked in? Like, you're not really in the value camp in the first place?
So we're not immune to anything. We're definitely not immune to what the market does. Nobody is. If the market goes down, we'll go down. If market goes up, we'll go up. Hopefully, when it goes down, we'll go down by a little less, and when it goes up, we'll go up by a little more. But in the average, we'll go up, in the long run, higher than the market. So we're not immune to that. I don't think when you describe how the media has characterized smart beta performance the last decade or so, I don't think that describes or descriptive of MarketGrader, and I don't say that in an arrogant way. I just say that if you think again about GAR, we have been harnessing growth. We have been harnessing sort of what the market's been giving you. To my earlier point, but being mindful of value. So are we on the super boom years where the Nasdaq 100 is up? Like last year, X%. Are we keeping up with that with a broad portfolio like this core portfolio? No, but we're also not going to have the drawdowns that it has, right? And so I think that narrative that you're describing is more relevant to some other smart beta companies that have, stayed with value because, research dating back, decades shows that, small cap value tends to outperform. But, markets change, and you need to focus on the companies that make up those exposures, right? And the point that I made before about low quality value stocks is super important. Those are value traps at the end of the day. So even if you screen for even if you want to stick with value, okay, screen for quality within those companies. Just it's not just value for the sake of buying cheapness. It's just value to be able to buy good companies at low valuations.
Yeah. And as Bill Sharp, as Harry Markowitz demonstrated many years ago, counter-cyclicality, or being able to zig when the market zags, or not have to worry about when the market zigs and zags, is value additive. So, if I'm your PR agent, like, I think what you just described is a huge benefit to MarketGrader that most other smart beta firms don't have. You don't have to worry about, okay, is now the time to get back into value? And if so, which smart beta firm should I pick? You can say, I don't care. I've got 24 factors. It's gonna straddle growth and value. I can kind of take that decision off my plate, because you probably know better than I do, Carlos. Factor rotation strategy has been like a holy grail, but no one's really cracked it that well. It's a tough nut to crack. It's tough to know exactly when to get in to one factor or the other, right? If you're playing it with a very small number of factors. So you kind of say, well, let's just invite them all to the table, and we'll just see which ones are relatively stronger at any point in time. So not having to make that decision, I would argue, is pretty valuable to investors.
Those are very challenging strategies, what you're describing, because, and this is the part that gets left out of a lot of the literature, they require market timing. You could have maybe the absolute best value exposure. Okay, when do you deploy it? Like, how do you know? You need to have perfect foresight to know that now is the time when we are rotating out of one and into the other. And you can add any other factors, right? So, yes, the idea is to always be focused on buying the best companies, systematically, and that's what MarketGrader does in our indexes and in these portfolios.
Awesome. Well, again, I'm biased. I'm biased, and I'm biased for a reason, though. But I think it's a good reason because of results, right? And in an era when 94% of large cap managers can't beat a benchmark, having a system in which 90% of nearly 100 portfolios do beat their benchmarks, I think is very valuable, Carlos. So, thank you for your time. First of all, if someone wants to learn more, at least on the BBA side, you can go to bbae.com/portfolios. It's not too hard to find. You just go to bba.com. If you forget that, you'll see it right there. If someone wants to learn more directly about MarketGrader, Carlos, would you send them to www.marketgrader.com?
MarketGrader.com, and we offer a 2-week free trial for them to see MarketGrader, including access to all our indexes and all the constituents.
Excellent. So even if you don't want to be a purist and use the kind of the broad model, you just want to pick and choose stocks, you can do that with that 2-week trial at MarketGrader.com as well. Carlos, always a pleasure to chat with you. Thank you so much for your time. And thanks to you guys, as always, for watching us at home.
Thank you, James.